Welcome back. Joining in to talk about their quarter gone by and the outlook is the management of eClerx. It's an IT company and they've reported a very strong quarter, a dollar revenue growth of 7.2%. That's an improvement seen on a quarter-on-quarter basis. In constant currency, it's a revenue growth of 7.6%. Again, sequential improvement, and margins have expanded for the company. We're now joined by PD Mundhra, the Executive Director of eClerx, on the show now. Mr. Mundhra, morning. This is Rima here. First, if you could give us a sense of what the organic growth for the company is going to look like on a full-year basis. You had previously spoken about a double-digit organic revenue growth for FY22. Now that the first half of the year is over, can you give us some more color on what the organic revenue could look like? Would it be in low teens, mid-teens, high teens?
Hi, Rima. Thank you for having us on.
And season's greetings to you first, Mr. Mundhra, and everyone at eClerx.
Thank you, and the same to you and the team at CNBC. We've had a strong quarter, as you just discussed, and we were up about 7% sequentially. I think, for now, the business momentum seems to be fairly strong, and we would expect that we will continue to see some growth over the rest of this year. As you know, we don't really have a policy of providing any specific quantitative guidance. But I think it's reasonable to assume that we were at about a $69 million run rate in Q2. So hopefully we should see some gains on that in Q3 and Q4.
Okay, so would that mean that you would perhaps look to revise your full year guidance higher? I mean, do you get the sense that the deal momentum is that strong?
So, we haven't really given any guidance in the past, any specific quantitative guidance. We don't do so as a practice simply because, the business is too small and individual events have very large impact. So it's difficult for us to give a narrow range of what outcomes will be. But broadly speaking, yes, you're right. I think the business environment in the wake of COVID downturn last year, after that has been quite supportive. We've seen decent traction both on top line and bottom line, and we would expect that to continue at least for the near future, the period for which we have visibility.
Okay, so you expect strong numbers in the demand environment to sustain. What about margins? Your margins have expanded sequentially. Could you give us a margin breakup? And what could be the margin range that you think you will be able to hold on to?
Yes, so, I think in Q1, we saw the effect of the wage hikes because for us that is effective April 1. So usually there is some challenge on margins in Q1, and over the course of the year, that effect normalizes. The other broad trend, I would want to point out is that over the last 1 year, we have seen clients become more amenable to offshoring a larger variety of work than they might have been pre-pandemic. And that has helped our offshore versus onshore revenue mix. So for instance, 4 quarters ago, onshore revenue was about 23% for us, whereas in this quarter, it was down to 20%. And that obviously, is a tailwind for margins because offshore work is typically more margin rich than onshore work. So that has been also one of the key drivers of, support on the bottom line, apart from cost heads like travel reducing sharply in the wake of COVID. So from that perspective, we feel that we should be able to maintain margins more or less in the range where they are now, if there is no, material change in operating environment.
Okay, so you'll be able to maintain margins. Now, Mr. Mundhra, I must admit, I did a double take when Rima shared the number with me on attrition. I mean, 41%, surely that is a huge concern for you and something that's top of mind. So what exactly is going on? How do you see this number shaping up? And, how much wage hike have you, for instance, taken? Will you have to do a lot more if you want to bring this down?
So by way of context, I think it's useful to look back for the last 3-4 years. Attrition for us typically is in the low 30s, 30 to 35%. And this year, obviously, it's been more elevated at 40-41% last quarter. I think for us, more important than the headline number of attrition is the breakdown in terms of who's leaving the firm. Because I think for a variety of frontline positions, we have a good way of hiring replacements and a reasonably good way of training them so that they can be effective and productive in their jobs. What really hurts us is if we start losing people who have deep subject matter expertise, who spent many years with the firm, who have client relationships, because that really is the DNA of the company to a degree. And fortunately, I would say for that group of employees, we haven't yet seen a material uptick in attrition. Having said all of that, talent market is stretched, as all of our industry peers are also reporting. we try to make sure that, apart from compensation raises, we try and provide a good work environment to our staff and enough learning opportunities. Because our belief is that at this juncture in their career, that is what people look for, apart from just near-term cash outcomes, which of course you have to match. So we feel reasonably comfortable. I think this situation may persist for a couple of quarters before perhaps early next fiscal year, attrition, hopefully will sort of revert to longer-term means.
Okay, so just one final question. We're running out of time, and it's two parts. One, is there a case to give another salary hike to your employees to bring it down? And B, after doing the buyback as well, you still have substantial amount of cash in your books. You've done the Personiv acquisition. Any more lined up?
So on the first question, I think we would like to stick to our standard appraisal timelines and policies. I would like to point out that last year, I think we were one of the first companies in our peer group that announced wage hikes, even in the midst of COVID. We went more or less as per our regular timelines last year, despite the uncertainty in the business environment. This year, we did the hikes again on April 1, and we will look to do it again, on April 1 next year. In terms of usage of cash, our policy has been fairly consistent, that it's either for acquisitions or return to shareholders. So as you noted, we've just completed the buyback. From an acquisition perspective, we keep looking, there's a fairly active deal pipeline, but I would say that, all the stars need to align for a transaction to complete in terms of finding the right asset, having the cultural fit with management, all the financial metrics working, the deal terms working out. So it's not a high yield process. If I look back in the last 8 years, we've done 3 or 4 deals, so that's one on average every 2 to 3 years. And we'd be happy, I think, if we can find one that meets all of our objectives in the near future. But nothing, concrete right now.
Okay, all right, got that. Thank you very much for joining in, Mr. Mundhra, and once again wish you and your team a very happy Diwali. So that is eClerx. We do have to take a very quick break on that note.